Part of me, Scott, just thinks this has just been a tough February, and it makes people feel like it's a bear market and we're down 1% for the month. I think March is going to be a turnaround month for the better.
That's Tom Lee, and he's not hedging. He's not saying maybe or possibly. He's calling March the turnaround month. February just closed in the red. Investors are nervous, and Wall Street is starting to whisper the words nobody wants to hear. Growth scare. But to understand why Tom Lee believes March will be different, and whether he's right, you need to understand everything that just happened, because the story is more complicated than it looks.
Tom, it just shows you that AI is everywhere, and it's in the conversation everywhere within governments, within this market. Market doesn't seem to know what to do with this trade from here. It's just nervous all the way across the board.
The market is rattled, and at the center of all that nervousness is one word: artificial intelligence. It was supposed to be the engine powering this bull run, but now investors are second-guessing everything. Is all this spending actually going to pay off? Is it creating jobs or killing them? Is it good for growth or just inflating a bubble? And then there's Nvidia, the company sitting at the very center of all of it. Its earnings just came in and blew every expectation out of the water, and yet the stock has been miserable. Whether you should be buying, holding, or walking away from Nvidia right now, that's still the question hanging over every investor's head. The fear is real, but Tom Lee thinks most people are completely misreading the situation.
We know AI is improving at an exponential rate. There's a lot of spending associated with AI, and of course now we're uncertain, like the path that it takes, whether or not it's actually a net positive for the economy.
That uncertainty is exactly what's been dragging markets lower all month. But Tom Lee has a perspective that cuts through the noise.
When it comes to the global implications of AI, it's really just the US and possibly China as the two real creators and beneficiaries of AI. And I think ultimately that also means that the S&P 500 should be a net beneficiary.
Think about what he's actually saying here. While the rest of the world debates artificial intelligence policy, two countries are building the thing, the United States and China. Everyone else is a consumer. And if you own the S&P 500, you own a massive piece of the companies driving that artificial intelligence revolution. Microsoft, Nvidia, Alphabet, Amazon, Meta. These aren't just tech stocks, they're the infrastructure of the next economic era. Tom Lee's argument is simple. The fear is overdone, and the long-term picture hasn't changed. But then came the question everyone was asking about: Nvidia.
What do you make of Nvidia's tough week? You couldn't ask for a better earnings report, one would think, and yet the stock's been miserable.
Here's what makes this so strange. Nvidia just reported one of the most impressive earnings results in the history of the stock market, and the stock got crushed anyway. How does that happen? How do you post numbers that most companies could only dream of, and still get punished by the market?
Yeah, I mean, I'm disappointed to see the stock not stronger off those results. I mean, how many companies can get 60 billion in revenues, guide to 70 billion in revenues, and that's, up over 70% year over year and 100% growth.
60 billion in revenue, guiding to 70 billion next quarter. Year over year growth of over 70%. Those are numbers that would make almost any company on the planet look like a superstar. And yet Nvidia's stock sat there like it had bad news to deliver. Tom Lee didn't hide his frustration with that reaction.
The PE of Nvidia now is at 19 times forward. So I think this harkens back to many times where Nvidia's price consolidated for periods of time and then it re-rated.
Here's the part that makes this really interesting. Nvidia is now trading at just 19 times forward earnings. That's not an expensive stock. In fact, when you compare it to something like Costco, a grocery store essentially, trading at nearly 50 times earnings, the gap becomes almost absurd. Tom Lee's point is sharp. The market isn't pricing Nvidia like a company growing at 100%. It's pricing it like something is wrong, and he thinks that's a mistake the market will eventually correct. These consolidation periods in Nvidia's history have always been followed by a significant re-rating higher. That pattern has played out before. Tom Lee believes it's playing out again right now. But while Nvidia was grabbing the headlines, something else was quietly building in the background. Something that doesn't get nearly as much attention, but probably should.
Yeah, private credit has been percolating as a problem for some time. We got some signs last year about this.
Private credit. If you're not familiar with it, here's the simple version. Private credit is lending that happens outside of traditional banks. It's grown enormously over the last decade as investors chased higher yields, but the problem with private credit is that it's not transparent. You can't see the cracks forming until they're already serious. And Tom Lee is saying those cracks have been forming for a while now.
I do think it does affect those who are invested in private credit. It does also argue the Fed needs to be thinking a lot more about where interest rate policy is.
This is the part of the conversation that carries the most weight, because if private credit starts to crack under the pressure of high interest rates, it doesn't stay contained. It bleeds into broader credit markets, it hits financial stocks, it raises questions about the entire lending environment, and it puts enormous pressure on the Federal Reserve to act. The good news, the market is already pricing in more Fed rate cuts than it was just a week ago. After the latest inflation data, expectations shifted from around 2 cuts this year to closer to 2.5. That's not a dramatic move, but in a nervous market, it matters. And speaking of nervous markets, let's come back to the call Tom Lee made at the very start.
If you look at things like rejection rates for trucking, it actually points to the economy probably accelerating. So I think if there is a growth scare, it's really just more of a risk premium than it is companies actually delivering news that would scare you about the economy.
Trucking rejection rates. It sounds like an obscure data point, but it's one of the cleanest real-time signals for economic activity. When trucking demand is rising and rejection rates are climbing, it means goods are moving, businesses are ordering, and the economy is running hot. That data point directly contradicts the narrative that the economy is stalling. Tom Lee isn't guessing here. He's pointing at ground-level evidence that the fear in the market is disconnected from what's actually happening in the real economy.
Tom, you warned us about this. I mean, you told us it wasn't going to be a linear year, that we were going to maybe get off to a good start, have some rough patches, and then, pick things up again.
And that's the final piece of this puzzle. Tom Lee didn't stumble into this call. He told investors at the start of the year that it wouldn't be smooth, that there would be rough patches, that the year wouldn't move in a straight line. February was that rough patch. And now he's saying March is where things start to turn back around. The investors who panic sold into this weakness could end up regretting it. The ones who held, or used the dip to add, may be sitting very well by the end of March,